Welcome to Fitz Factor, the show where you learn how to master the stock market with Dan Fitzpatrick, the stock market mentor. Dan is a savvy trader. He's featured regularly on Fox Business, CNBC, Investors Business Daily, and SiriusXM Radio. In this podcast, Dan shares his insights on trading, life, and attaining long-term success in the market.
So in a recent podcast, I was talking about the importance of controlling or mastering your emotions in trading. More specifically and to the point, the weakest link in your trading, process is you. If you get emotional, you're really going to get screwed up. You're really going to be wrapped around the axle and doing the exact wrong thing at the exact wrong time until, finally you're just going to wind up giving up the game and say, well, the market's rigged. It's not for me, et cetera, et cetera. And the real issue is that you just haven't quite figured out how to manage your emotions. So I talked about some of the things that you needed to do, such as developing a trading plan, which really takes your emotions out of it. It's kind of like a pre-flight checklist where you got to go through the list and you have determined and resolved up front that this is my trading plan. And if the stock does not meet my criteria, then it's dead to me. It's just not a stock that I'm going to trade. Now, when you do that, you will find out that you're going to screw up a lot. And the reason is because you kind of naturally and subconsciously avoid sticking with your plan because of that tried and true phrase, this time is different. And it's going to take you several mistakes, and you get to choose how many, before you finally realize that actually maybe once in a blue moon, this time might be different, but I don't really bank on this time being the blue moon time. So you just stick with your plan. And after a while, you will realize that you're not so emotional because, you have your plan, you're sticking to your plan, and then the trade's either going to work out until it doesn't. And that's okay too, because that's a part of your plan. You build in failure, you build in a loss into your plan, and then you're a little bit more dispassionate about how you view that trade. It's just a process. So what are some of the challenges of overtrading other than managing your emotions? Probably the biggest one is overtrading, which is actually kind of a cousin of bad emotional control. Now, overtrading, think about it. Overtrading is caused by several things, maybe all of the above. Impatience, where you're sitting around looking for action. Every once in a while, I'll come into our trading room in the morning and I'll see somebody or several people just itching to trade. And their general question is, okay, what are we playing today? And that's, I don't... Look, maybe you're going to play the right game, but maybe you're going to play the wrong game. And it kind of avoids or sidesteps the actual important thing about trading, which is what's your plan? So you're not really looking for stocks. You're looking for stocks that suit your plan. And if you can't find those, then you're not going to make a trade. You don't lower your standards. That's the way I look at it. If you have certain standards and things, whether it's friends, spouses, business deals, whatever, you don't lower your standards just because you can't find something to meet the standards. You got to hold the line here. And so you don't want to be so impatient that, oh, all to hell with my plan. I just want to trade. So another reason why a lot of people tend to overtrade is just flat out greed. I want more. I want more. I always want to make more money. Oh, crap. I lost money on the last trade. I'm going to get that stock back. I'm going to make money. Like, you're never really content with a profit. You want to get it all. And you get mad when you don't. And I say, as well as many, many, many very profitable traders, that what you're wanting to be doing is selling into strength. When others are really, really wanting the stock that you own, give them some. You don't have to give it all to them if you don't want to. But, be a philanthropist. If somebody really, really wants to buy your stock, strike a deal with them. Okay, well, you can buy it. It's a really high price, much higher than I paid for it. But if you want it, come get my offer. That's really the way you want to be trading. And you can always hold some back. I always suggest that if you've got a stock that's working in your favor, go ahead and just kind of wallpaper some stuff. Just put some and say, you know what, until this thing, and then fill in the blank, until it falls below the 200-day moving average, until it falls below the prior week's intraday low, whatever your time frame is, have some kind of benchmark, some kind of criteria for what it's going to take for you to sell it all. You can be trading around the rest of your position, but always have some criteria for being able to know when it's time to just sell it all and get out of the trade. But what I see with a lot of people is and I've seen this in myself too. Self-awareness is a beautiful thing, but it's also pretty darn humbling. Where you're in a trade and you like the way the stock's moving and you say, hey, Dan says sell into strength. So you sell it all. And then the stock moves up a bit more and you're going, crap, I shouldn't have sold it all. Well, maybe I'll just buy some back. And then you buy some back at a higher price. And then the stock pulls back just a little bit and say, well, crap, I shouldn't have bought it back. I'm glad I sold the first time. And then that cycle repeats itself. The stock pulls back a little bit, so you sell. And then the stock recovers and starts moving again. Then you buy it back. Stock moves up a little bit, and then it starts pulling back and you sell it again. And this goes on and on and on. And the reason is because you've got this greedy nature that wants to get it all. And by God, I'm going to get back at that stock. I'm going to make so much money. I'm going to get back at that stock. So that's another, and I'll talk more about that in a couple minutes, but that's another big problem that people have is greed, a desire for more. Like, what's your number, dude? More. Really? What price do you want to sell? Higher. Well, how about if it gets to here? Well, sure, but then more than that. So don't do that, okay? Greed is not good. I don't care what Gordon Gekko said. If you recall, the guy wound up in jail for a long time. So you don't want to go there. Now, another issue is just your desire to recover losses. When you trade a stock and you lose money on it, a lot of people will take it personally and get back at that stock. They're going to say, damn it, I'm going to buy Apple, even though it's not really working really well, because I took a loss on that and I'm going to get that money back. Or whatever your stock is, Marathon Digital, C3, you name it. We can look at a bunch of them. But what happens is you lose money on a trade and you really, really feel like you should have made money on that trade. You should have made money, but you didn't. And so you're going to get that stock back. You're not looking at yourself. You're not thinking about yourself and considering that maybe you're doing something wrong. Instead, no, I'm focused on the stock. I'm going to get my money back. Now, that's a problem. Because if you're thinking, even if it's not even a particular stock that you want to get revenge on, let's think about losses for a second. A lot of times, again, I've fallen prey to this too, though happily some years ago, I stopped, dealing with this emotion where I lost money and I need to get the money back. I need to get my money back. Several years ago, it's probably 20 years ago, I heard from a reader when I was still writing for thestreet.com, a very, very sad email. And he was he owned a few dry cleaners, Filipino guy. And as is typical for immigrants just coming over, he had like his whole family, extended family living in the same apartment. But he did have $50,000. And so that's great. Except that this was during the .com bust, and he winds up losing all of his money. And so he asked me if I had a stock that I could suggest to him where he could make all his money back. And it just kind of broke my heart because here's a guy working really, really hard, trying to make a better life for his family, working hard, trying to make money in the market, and he lost it all, but he didn't really understand the mathematics of trading. If you lose 50%, you got to double your money just to get back to even. If you lose 80%, you got to make 500% just to get back to even. And the real question you need to be asking yourself is, well, wait a minute. If I'm such a poor trader that I lost 50%, what makes me think that I'm going to be magically such a good trader that I'm going to make 100%?
If you're getting value from this podcast, click the subscribe button and sign up for Dan's free daily videos at stockmarketmentor.com.
I mean, guys, this is real math. And this is the thing that most people don't get. And it's because they're busy looking at the lines and the boxes and the moving averages and the tape and all that. There's just so much on your monitor that you're always preoccupied with that. You never really stop. You never really stand back and say, wait a minute, what am I doing here? What's really happening with me? I have losses, but is trading the same way as I traded in order to incur those losses? Is trading the same way going to help me get my money back? And the answer is no, absolutely not. We don't want to be trading. We don't want to be trading profitably. We want to be trading well. If you're trading well, the profits will come. If all you're thinking about doing is making a buck, I just want to make money, then you may do very well all the way up until the time that you don't. It's because you're focusing on the dollars rather than the technique, rather than the method, rather than the process. So that is not the way for you to make money. And it does lead directly to overtrading. Whenever you're thinking about how much money you have lost, you're not going to get it back by doing nothing. That's just human nature. We got to work hard to get it back. Don't do that. Again, the math just doesn't work. And so don't try to make it work. Don't, new math, old math. Hey, man, it's just multiplication, subtraction, division, and addition. That's all it is. The big four. Know those, and you're going to be fine. Now, another way to that causes overtrading, another thing that causes overtrading is just simply regret. You just regret. Let's say you thought a stock was done. I don't buy falling knives. I just get a bloody hand. I don't buy falling knives, but a lot of people do. You say, well, I think the stock's gone down enough. The stock's gone down enough, so I'm going to go buy this stock and catch it right at the bottom. So then what invariably happens is that you buy the stock, bounces a little bit, and you're feeling awesome. And then it falls right down through your entry point and keeps on going. It's almost a guarantee. And so then what happens? So you had to sell it for a loss. And now you are bound and determined to buy that. You're definitely going to catch the bottom this time. And you can wind up doing it over and over again. And maybe you do wind up catching the bottom, but you've also bought it at the last 5 bottoms that turned out not to be bottoms. This is all something that happens when you are overtrading, when you don't have a method, when you don't have a process. So how do we know whether we're doing this stuff? How do we know? Because, if you can't measure it, you don't know whether you're getting it done or not. You have no idea. So how do we know whether we are overtrading? First thing is this. If you're making really, really good money the way you're trading, don't change a thing. Just keep on doing it. Keep doing the same thing that's making you money. But let's say you're not. Okay, here are a few things that you can do really, really easy. First, how many tickers are you trading? How many stocks are you trading right now? Like how many stocks are in your trading account right now? Do you have 20? Well, why don't you just buy the NASDAQ 100 and be done with it? 20 is too many. 10? I would never have more than 10. I'm talking trading account, not investing. I would never have more than 10 in my account. And typically it's about half that because I want to just know what I own. I want to be familiar with the way those stocks trade. And I want to have my mind right. I mentioned that in my last episode here, where I'm talking about the benefit of being quiet, of having quiet time and thinking about what you're doing, thinking about your mindset, think about how your level of emotion, think about what your processes have been. Is anything bugging you? Are you feeling awesome, so awesome that you're dangerous? Or are you feeling depressed, so depressed that you're bound and determined to lose more money because that's what depressed people do? Depressed people say, well, I'm not very good. You feel bad about yourself. And so subconsciously, you think that you deserve to lose money. And lo and behold, you do. And so, these are things that you're going to have to deal with. But it really does come down to how many stocks do you have in your account? If you can't name them for me right now, then you probably have too many in your account. I'll emphasize one more time. I'm not talking about investing accounts where you can have exposure to all kinds of different sectors and stuff like that. I'm talking about your active trading account. You should be able to tick those tickers off, say exactly what you own. If you can't do that, then you're not really properly positioned. The next thing is just counting your trades. Look back on the prior week. Now, trading is essentially free. There are no commissions. It may be $1 or 50 cents an option contract or whatever. But for all intents and purposes, trading's free. And that's good and bad because there is no instant consequence to you buying a stock. There's no $7 penalty when you first get in the door. Now, back when I first started investing, this was back in the late 80s, and I didn't know what I was doing. I wasn't trying to be a trader. I just had money and I wanted to put it into a stock. And I got, I think it was the Richard Band newsletter. And yes, it came by mail. That was more like Pony Express as opposed to the internet. It came by mail, and he really liked IBM. So I'd opened up a brokerage account, and then I decided to buy some IBM. And the commission was over $100. I think it was something like $130. And I think I had a $3,000 investment, something like that. It was massive. Well, now you can trade and invest for free. How does this apply to overtrading? This is how. Count up the number of trades that you've made. I don't care if it's winners or losers. I'm talking about exchanging money for stock or stock for money. Count up the number of trades. Multiply that by 7. You're basically assuming that you were trading old school where trading commissions were $7 each side. So you're multiplying all of your trades, buying or selling, by 7. Now, compare that total with what you're actually gaining or losing in your trading account. When you stack up those theoretical commissions with those reality-based numbers as far as making or losing money, how is that looking? Because let's say you're trading and you got a little, you're up on the year, maybe just a little bit, maybe down on the year. That's horrible with what I'm going to say now, but maybe you're up just a little bit. You say, okay, well, hey, I'm up 4, 5, 6, 7, 8, 10% this year. I think I'm doing pretty good. Okay, fine. Now subtract from your gains the total of theoretical commissions that you have had to pay. Now, how are you doing? That's a great benchmark for you understanding whether you are trading too much. Do the exchange costs, do the commissions outweigh the money that you're making? If they do, you really need to get your stuff figured out because it's not good money management. It's not good trade behavior management. So, okay. And then another way is add your winners up. Parse all of your trades into 2 groups. Winning trades, I don't care if it was $1, and losing trades. I don't care if it's $1 or $1,000 or $1 million. Like what's my batting average? What's my W? What's my L? And then look at that as far as what is my percentage? If you've got, the same number of gains as losses, then you're batting 500. If you're making money on 3 out of 10 trades, then you're batting 300. That's it. Just simple things like that. And then go on and say, all right, I just want to look at my winners. Add them all up. What's your gain? How much have you made on your winners in sum? Then add up your losers. How much have you lost in all of the cumulative total of all your losses? What's the ratio between the two? In just very, very simple terms. is the sum of my gains greater or less than the sum of my losses? That gives you a pretty good, it gives you an excellent benchmark for whether you're making or losing money. I mean, that's the easiest damn thing in the world. But then we have to go a step further and say, okay, how many trades did it take me to make money? And how many trades did it take me to lose that money? So then we'll start this way, and write this down. I mean, this is really important. You take the sum of all the gains that you've made. What is that dollar amount? And then divide it by the number of trades that you have made on the positive side of the ledger. So what you're getting is the average gain that you made on each winning trade. Forget about the losers for a second. On your winning trades, how much is the average gain that you have? And then you do the same thing for your losers. What is your average loss in all of your losing trades? Then you compare that. You look at your batting average, what's your win-loss ratio, and then you look at how much do I typically make on winners and how much do I typically lose on losers. And those are the numbers that you have to deal with. Because once you have a handle on those, there's two things that are really, really important. First of all, make sure that you're making more money on your winning trades than you are losing money on your losing trades. I'm not talking about batting average. I'm just saying, on every, assuming your position sizes are all the same, so we don't have to talk about dollars, assuming that you're making an average of 15% on your profitable trades, and you're losing an average of 15% on your losing trades, and you're batting 500, so you're breaking even. And then, of course, subtract your theoretical commissions on top of that. The conclusion is, I think I kind of suck. So what you're looking for is this. Let's say you're making 15% on your profitable trades, and you're losing 5%, 8%, 3%. I like to keep mine pretty tight whenever possible. And you're losing just a fraction of the money that you're making, again, on a percentage basis. If that is your ratio, you can have more losing trades than profitable trades. You're losing 5% on your losing trades, but you're making 15% on your winning trades. Okay, those are some really good numbers. I don't care if you're only batting 300. You're going to make money on a 15% gain and a 5% loss average. So these are some of the things that you need to do in order to see exactly where you are. Exactly where you are. Now, what you want to do is this. So you kind of have your numbers. Step back. Zoom out. Look at the week. If you're a shorter term trader, look at the weekly chart of the stocks that you've traded. If you want to go through the trouble, and I do think it's worth it, print out charts of the stocks that you have traded and mark where you bought and where you sold. Now, you zoom out, look at the weekly chart, and then ask yourself, why did I buy there? Why did I sell there? Does it make sense? If you're seeing that you've got a nice uptrending stock like an NVIDIA or there's any number of them that have been doing that this year, certainly Tesla, Apple, Amazon, things like that, Meta. You look at a chart like that and you see all these little red dots and all these little green dots, but you don't hold any of that stock in your account now. What you're seeing is that you could have just sat there and rode the lightning, man. Just buy the stock, let other buyers push it higher. You don't really have to do anything. You let the market be the wind beneath your wings. You'd make Bette Midler proud. This is the way you'll wind up seeing whether you are overtrading or not. And so if you could just kind of follow these simple thoughts, I think you're going to find that you're trading a lot better. How many tickers are you trading? Again, are you like a ping pong ball in a clothes dryer where anytime the dryer's going, you're all over the place? How many tickers are you trading? Are you trading one stock 15 times? I mean, come on. So you want to know how many tickers you're trading. You want to count how many trades per week you are making. Is it ridiculous? Multiply by 7. What's that number? Find out what your percentage is, your percentage win-loss. How much are you making on winning? How much are you losing on losing trades? Do these types of things. Zoom out, get a big picture of what you're doing and what you have done after the fact. Don't just make a trade and forget about it. You got to log it and you have to be responsible for it. You have to look back a week from now, a month from now, at the end of the year, whatever. I recommend doing it as often and as soon as you can to find out whether you are overtrading or not. There is no such thing as far as a good thing as trading harder. I've heard people say, well, I just need to trade hard. You know, I think, well, why don't you just give me your money? Because trading is not supposed to be hard. It's actually supposed to be easy. Managing your emotions is what makes it hard. But if you can manage your emotions and have a process that you can stick to, if you have enough discipline to actually ingrain a habit within you to follow your process, trading is actually really easy because you're not going to have that many things to choose from. When I go to a restaurant and they've got these ridiculous menus that go on for pages and pages, and there's every damn thing imaginable that you can choose from. I mean, one thing I think of is, how's the guy in the back that's cooking this? How's he good at all that? That would be like me saying I'm an expert at trading. Every kind of trading I'm an expert at. No, I want the guy who can cook the best steak or whatever your food choice is. But when I see so many choices, I can't choose. I have no idea what I'm supposed to buy. I can't make a decision. I'm indecisive. So what do? When the server comes up, I say, hey man, what's the most popular dish here? They always tell you. They always know. And I'll say, okay, give me that. And unless it has anchovies. So if you can just be thinking along these lines, you're going to find out that overtrading is a thing of your past. And profits and good trades, good trading tactics are going to be in your future. So what we got to do is bridge what's in the past to what's in the future. And that starts with right now. I'll see you next time.
Thanks for listening to Fitz Factor with Dan Fitzpatrick. If you like this, then you'll love Dan's premium service at stockmarketmentor.com, where you can learn how to trade stocks, options, and cryptocurrencies. Click the link below and get access to real-time trading alerts, a community of traders just like you, and live training sessions each week. Get the trading edge that you need at stockmarketmentor.com.